Okay, excellent. Well, welcome everyone, members and visitors. My name is Brent Gall. I'm the president of Yankee Model Investment Club. This is going to be a kind of a new experiment for us. We have a bunch of people signed up for this meeting, and it's our first time kind of presenting to a large crowd. So we'll take things as they come, but I wanted to just walk through a couple of slides to talk about our club. We are a better investing model investment club, and that basically means that we are a fully functional investment club with real money, but we are open to observation by the public. And we open our doors up just to encourage the use and participation in investment clubs, and it allows people to see how they operate, ask questions, and figure out for themselves if being in an investment club is something that they'd like to do. Our club was formed in 2008. We currently have 4 members spread across Connecticut, Massachusetts, and California. We are online starting back in 2011, and we meet monthly on the same day, second Saturday at 11 a.m. Eastern. We're always looking for new members. You don't require any investment experience. We mentor any new candidates and walk them through the guidelines and best practices from better investing. There's really no limitation on which state you live in, except where the tax laws require the club to file a return on your behalf. So we encourage looking into that if you're interested in joining. For all partners, you must be a member of Better Investing. You're expected to actively participate in the club's activities, and each member makes a stock presentation using the stock selection guide, which is the tool that Better Investing has for us in rotation with other members. And then for operations, follow Better Investing principles, show respect to your fellow club members, since we are all still learning this process. We'll perform annual audits, file tax returns promptly and deliver K-1s timely, and then follow our partnership agreement and bylaws. Any questions, or if you're interested in joining, contact Jack Finn, and that's his email address there at the bottom of the screen. Just a brief overview of the structure of the meeting. In a few moments, I'll show the agenda. It's basically the same agenda form that we use every month. All visitors will be muted, but you can ask questions, and Joe Farrell will answer them. There's a question box in the GoToWebinar control panel that is probably over on the right-hand side of your screen. It says questions, and you can type a question into the box, and then Joe will highlight the answer. And I think you should be able to see all of the other questions that have been asked by the other attendees. So scroll through those to see if your question's already been answered. And then finally, just a disclaimer, here's the fine print, but in general, we are not financial advisors. We are not giving financial advice. Any investment discussions or investment candidates for companies, you should do your own research and make your own decisions before putting your money into any of those securities. Okay, that's it for the introduction. I will move on now to the agenda. And as I mentioned previously, this is our standard form agenda. Consider you welcome. Don't really have any other announcements. We have a short educational segment that each of our members do on a rotating basis. So I will hand it over to Steve for his presentation.
Hi, everybody. My name's Steve Roy, and what I'm going to do today is 2 presentations that'll be very brief. One is on Value Line, and I got this presentation from, I borrowed it, I should say, from Better Investing. One of the first things that I learned about investing, and I had always gone to the library and looked at value line, but I didn't know what it meant. And so I'll never forget when somebody from our club explained it, and it really resonated with me. It stuck with me. So I'm trying to get to the right screen. Here we go. So what is the value line, and why is it so important? So what I want to do is I'll just show you that here this solid line is in fact the value line, but I really wanted to know what it was. So if we want to know what it is, let me just search for cash flow here, because it's really called the cash flow line. So is this not searching like normal? Oh, okay. Oh, here we go. Okay, so what it is it's taking, I'm just going to read it because I'm not doing too well here. So so we look at the cash flow line, or the value line, and it's the solid line. And what it is, it's the part that I wanted to impart was that I thought was particularly important was when, I don't know if you can see my mouse here that I'm shaking, but it becomes dotted. And where it becomes dotted is the estimate. And part of the power of this thing is that, of course, they have the history of the cash flow, and they say how it's calculated here. It's in depth. But what I wanted to impart about it was they actually have a human being, and they're doing a curve fit. So I thought that was extremely powerful, and I wanted to pass that on. And if you Google it, you'll be able to find, there's it's called the In-Depth Guide to Reading a Value Line and Research Format Report. So, and the basic thing is, so we know that it's cash flow, and we know that a human being has put a multiplier on here to make it curve fit and make it make sense in regard to future projections. And so the dot here is the current stock price. And if you're above the value line, perhaps it's overvalued. If you're below, you're undervalued, and you might be a good buy. And it's a way to instantaneously just see, oh, are they above or below the line, the cash flow line, the value line? And when I found that out, I thought it was super neato, and I wanted to make sure to share that with everybody. Now I'm going to jump into my other presentation. This one I made from scratch. And I thought it was extremely timely. It's the mathematics of percentages. And here's my personal disclaimer. The following presentation is my opinion only and not financial advice. Nothing is expressed or implied in these slides or in the entirety of my presentation. So I hope that is the sincerest enough of a disclaimer. So if a portfolio goes down by 10%, how much does it have to go back up to get even? Okay, 10%, right? Yeah, that's wrong. So it has to go back up 11.11% to get back to where you started from. Okay, so why is that? Why does the portfolio have to go up more than it did? Why does it have to go up more than it went down to get back to even? So in general, if your losses are here, and that's this portfolio loss. So, and in this example, we're using a loss of 8%. Then it means that your portfolio has been multiplied by 1 minus R. And then to regain the loss, to get back to where you were, your portfolio has to be divided by 1 minus R. And that's what you really need to know. That's why you have to go up more than you went down. And so how do you see this? What's the visual expression of these formulas? And so here we go. And so what we'll do is we'll blow this up a little bit, and we'll just take a quick peek at this. So this is a gain versus loss chart. So on the bottom, the x-axis is the percentage of portfolio decrease, and on the y-axis is the percentage your portfolio has to go back up to get back up to even. So as we start, if the portfolio goes down 10%, it's 11.11%. It's got to go back up. At 20% down, you got to go back up 25%. And at 50% down, your portfolio has to go up 100% or twice. Okay, so we'll escape out of that, and then we'll go down now to the next slide. So what I did was I broke these up because when you start getting to the end of the curve, it compresses it and you don't see it that well. So I blocked it out from 0 to 50, and then to 50 to 90, and then from 90 to 100, it really goes crazy. So then I made another graph for that too. So just to take a quick peek here on this one, another in-depth one. And this one, if you'll notice, it's not the normal X scale here. I'm not offset by 5s. I'm offset by 6s. And one of these is 86%. So I'm circling it with the mouse here, 86% if your portfolio loses that much. And why I brought that out was because that is the amount that happened during the Great Depression. And so for 86% down of your portfolio, it has to go up about 614%, or 7 times to get back to where you started from. We'll go to the next slide. And this is, I find this very, very interesting. So then when you're in this zone, to get back to where you were, you start getting into thousands of percents. And of course, at 99%, you're at 10,000. And then when you're at 100% loss, of course, you're at 0. So that's why this graph looks like this. So it should be fairly straightforward to understand this. So what's conventional thinking? So conventional thinking is a 50% loss in your portfolio means that you must get 100% gain in order to recover your initial portfolio, and scary, right? So I can assure you that in 2008, when my portfolio went down 50%, I was scared to death. It's petrified. Right? So in order to use the mathematics of percentages, you have to have glass full thinking. You have to turn it around and use it to your advantage. And so I put 2 Buffettisms here that I really like. And the first one is, you have to be fearful when others are greedy, and greedy when others are fearful. The second one, and my most favorite one, is this one. Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. When downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons, and we will do that. So another way of looking at this, instead of in the negative way, in the positive way, is that it's the stock is going to revert to its mean. So it's going to go, the stock is going to go back trading at its average price over a long period of time. So this method is not for the short-term investor. And this is why this is pitching it, because I am not a short-term investor. This perfectly fits my stock buying style. When I buy a stock, I'm married to it. I keep it forever. So this works perfectly for me. So this is why I like this method. Because it's going to take time, sometimes several years, for the stock to trade back at its average price again. So how do we use the mathematics of percentages in this time of high volatility? We buy companies with excellent balance sheets following better investing guidelines. And we select a company, we make a plan, and we stick to it. And you let the market come to you. You don't follow or chase the market. So with this, you kind of have to pre-select your value that you're willing to pay. And so then I have an example of this. So at first, I just use an index for a quick example, and then I'll use a stock. But I think this illustrates it nicely. So this is looking at the S&P 500, and particularly I happen to follow the SPY, the SPYs. So we peaked at February 19th at 339.08. And then the trough, when I first started looking at this, when it caught my attention that there might be some possibility to use mathematics of percentages, it was at 273. And then lo and behold, we hit another trough value, another much lower value at 218. So you can see that here the volatility normally through 52 weeks was about 65, but through the recent, with the corona, you can see it's doubled that, right? The swings have been violent, minus 120. And then just on Thursday, it closed at 278. So what does this mean? So let's blow this up a little bit so you can see it a little clearer. Okay. So if we have the peak, the 52-week high, that's our 0 point, right? And then as we come down, now these are just suggested points here, but if you pre-map it, then all of a sudden it becomes very clear, at least to me, what you're going to do. So, and these are just, I just happen to pick these values. Now the 20% where I initially had everything at a quarter, but I reduced it to actually a 20%. So instead of 4 buys, 5 buys. And actually I had seen an interview with Muhammad El-Arian and he suggested 20%. And I said, yeah, that's safer. I'm going to do that. So, and the point being that, I'm certainly hoping that, I don't have to buy at the 86% level. And what's the worst thing that's going to happen? I'll have cash of whatever my allocation was. I'll have 20% extra cash. So this is kind of just I want to go back a slide here just to get, just to show something. Whoops. Yeah, so our close was 278. And so if we look down, we can see exactly where that fits in here. And so we're over bear market. So we're between 15 and 20%. Okay. So, and then on the next one, the actually stock I picked was because I know that Brent doesn't like Facebook. So that's why I picked it, believe it or not. And Facebook just happens to be a fortress balance sheet stock, which is quite frankly the only kind of stock that I will touch. So especially in these days and what I feel is coming. So let's take a quick peek at Facebook. The peak, the 52-week peak, was at 224. The trough was at 137. So you can see there was an $87 swing on a fortress balance sheet stock. Its 100-day moving average was 195. So let's take a quick peek at this. And I think this illustrates it very nicely. When you do your work ahead of time, then you can pick your points here. So when I do a SSG on Facebook, it's telling me that it would buy up to 144. And it's in the 170s now, right? So it's in the 170s. SSG is telling me. So that's over a 35% discount to what its peak trading was. And so I just happened to lay these in just because this is what I had selected, but you certainly don't have to keep it that. This is just ultra conservative. If this hits, I believe that Facebook is a fortress balance sheet. I don't think it's going away. I know that Mr. Zuckerberg runs it, and that is not all of our club members like that. But I think it's perhaps it might be something worth to look at. So some takeaways that I want you to have from this. So in order to make money in the market, and when I've done it, I've actually done this, and I did it with Sirius Satellite Radio in 2008. I set a limit of 8 cents, and lo and behold, it hit the 8 cents limit, and I still have every share that I ever bought from it. So I know that this works. it just takes a very long. It took 11 years to get back up to $7 a share, but I bought a fairly large amount at 8 cents a share. So I know that this works. And so we are a growth, we're GARP, so growth at a reasonable price, kind of a club. So here you don't have to pay nosebleed prices for fortress balance stocks because the market is swinging so hard. It's going up, it's going down. But if you put your orders in and you know where you're going to put them in, you can catch those dips. And so make a plan and stick with it. All bear markets recover, at least they have so far. So, and use the leverage and leverage the mathematics of percentages to your advantage. If this has piqued your interest and you want to see a little bit more, this is where I first saw this. Was if you Google gummy stock and then you look for portfolio blues and you see this financial wisdom forum, you can actually find it a little, it's a really good explanation of it, actually. And then if you Google percentage and loss, the Bogleheads have a really nice chart that shows it, how powerful buying low is, and having the stock return to the mean. And then if you Google returns needed to recover a stock market loss, Zacks Financial has a wonderful write-up that explains it in very plain English on how this works. And I'd like to leave you with one final thing from one of my most favorite quotes ever, and it's from the Roman philosopher Seneca. So, luck is what happens when preparation meets opportunity, and you need to put yourself in a position to have luck. And so with that concludes my presentation. Brent, back to you.
Okay, thank you, Steve. Very good. Appreciate it. Out of curiosity, the GARP Model Club term, did you come up with that, or is that a?
No, that's Ira said, because I said we were deep value, and he said, no, we're growth at a reasonable price. So,
nice. Okay.
Yeah, so that's kind of, I use that.
Okay. Thanks. Okay. Let's see. Moving on then. We will move to the club secretary report. So Jack, I will make you presenter. Are you with us, Jack?
Okay, sorry, I was muted for a second.
Okay.
So this is the minutes from last meeting. We had a fair number, what I thought was a lot of visitors last week, but last month, but we're blowing it away this month. 33 people registered and 9 visitors were with us last month.
Could you zoom in just a little bit?
I'm trying to figure out how to do that.
I think bottom right of the window there's the little, yeah.
Oh, I see, okay.
Perfect, thank you.
Our minutes are up on our Bivio site, but I also send them out to all visitors and attendees. The treasurer's report last time was accepted as presented. These are our positions. We have 12 stocks. Let's see. This is our size diversification. We're a little overweighted in large stocks, the green here. Our goal is to have 25% large, 50% medium, and 25% small, but we're kind of uneven. We need to work on that. Okay. Last month, I presented National Mortgage Insurance Holdings, which is a direct competitor with one of our stocks, Essent. And we decided to stick with Essent and not do National Mortgage. They both do private mortgage insurance. We did have a few $100, how much? $870 to spend, and we bought Tractor Supply. We'll get to that, what we bought it at in a second. And last month, Brent presented a show on Challenge software in Toolkit 6 and other places in Better Investing. Steve sent the completed partnership agreement to IRA, so that's complete. Steve, I think you still need to check on the Better Investing email. That they had made you inactive for some reason, and so that's why that didn't happen. But let's see. And this week, this month, Ira is going to present the stock study, and Steve just presented the education report. I record who visited, or the number of the visitors we got to Better Investing, and we had a fair amount of discussion last month on from the visiting attendees, and that's it for the minutes.
Okay, thank you very much. Hearing no objection, we'll accept as presented. And then move on to Treasurer's Report. So Ira, I'll make you a presenter.
Okay, you see my screen?
Yep.
Yep.
And here's the current holdings that we have. Member status report. Jack, you were negative there for a while.
Yeah, I was.
One of the questions that was asked was, is this a real money club? And I said yes, and noted that the amount that each of you deposits variable to a certain extent. I did not explain the pennies method, but anybody can see that that's what goes on. They choose to deposit whatever they want, but they put in the amount of pennies, and that helps the treasurer know who made a deposit.
Right.
We use TD Ameritrade right now, and everyone does direct deposit to TD Ameritrade. So that makes my job as treasurer a lot easier. And then I know we use Vivio, which I'm showing right now for club accounting. And I know who sent in what, because they each have a cent assigned to them. So Jack, for example, puts in $100, and what's your cent?
3 cents.
3 cents, 100,000, 3 cents. So I know that comes from him.
And it might be worth mentioning that the $200 or $100 per month is, because we're such a small club, we agreed amongst ourselves to contribute a fairly high amount monthly so that we would have a sizable chunk to invest. But there's currently shouldn't be a barrier to new members. We can discuss what a reasonable monthly allotment is, or monthly payment is, and it just works out that you then are buying in as a smaller piece of the pie each month for the contribution.
Right, and in addition, even if you put in $25 a month, you still have an equal vote to everybody else in this club.
That's true. Yep. Thank you.
Transaction history, you can see we purchased last time 12 shares of Tractor Supply at $72. We picked up a few dividends. You can see Tractor Supply $29.75, Essent $51.52, Lithia $36.90, and all the member payments are up to date. Performance benchmark. So since inception of the club in 2008, we have an annualized return of 9.3% versus the current Vanguard 500 index of 10.5%. We usually look shorter term. Just for fun. And you can see that it's gone down quite a bit here.
Well, that's not fun at all.
That's not fun, no. And here's investment performance report. Regeneron is doing the best at the moment.
Yep.
And member performance report. And that's all. Any questions?
No, it looks good. Thanks, Ira.
Okay, we could move right on to the stock study. So this month I selected Five Below as a stock to study, and start off with a spoiler alert. Since I selected this over a week ago, it's gone up about 10 points, and it's now in my hold range.
Uh-oh.
So I'm not going to recommend that we buy it now. However, with the market volatility, the VIX index, the way it is, it could easily retest the lows. This stock at the low was in the 40s, and now it's in the 80s. So that just shows how volatile the market is at the moment. So with that said, we can still review it. So Five Below is traded on NASDAQ. It's a mid-cap stock, and that's one reason I picked it, because we're trying to have 50% of our holdings in that range. They have approximately 1.8 billion in sales. So you can see here, Five Below, they're in the consumer discretionary group. They're a value retailer that offers a broad range of merchandise, and they cater to the teen and preteen market. Almost everything is priced at $5 or below, hence the name. These are the product categories you can see yourself. They have 900 locations. They're all shut down right now. They're in 33 states. They typically have a store of 8,500 square feet, and they are aggressively adding about 200 stores a year with a goal of 2,500 stores. So I'm going to show you their investor. This is from their investor relations page to show how they've grown over the years here. You can read that yourself. 150 stores opened recently in 2019 and 900 total. This is their focus. So whatever the current trend is, they are on it. So if you have fidget spinners, that's where you're going to buy them. is their target audience. Just let you look at this for a little bit.
What does dwell time mean?
I have no clue.
I think it means how long they spend in the store.
Yeah, probably. Trend right, Wow products. You know, I've been in this store. I bought things for, I have an iPhone. And if you want a $5 charger, that works fine. If you want a screen cover, this is the place to go, $5. $1.8 billion in sales.
It's certainly the most colorful investment presentation I've seen, so I'll give them that.
I'll just zoom through it here. So they do have an online presence at the moment, and they are selling online, but it's a small fraction of their normal business.
It looked to me like most of their sales are in the fourth quarter. Is that right? Most of their profit, anyway, is in the fourth quarter.
Yeah, and they did miss on the last holiday season, and I'll get into that in a little while. This is what their stores look like. You can see they've been growing sales 24%, income 32%, earnings per share 31%. And this has been consistent over the years until, of course, now every store is shut down. But this too shall pass. This is where they're located. And like I said, they want to have 2,500 stores. If you want to buy a $5 quadcopter, this is where you go. Okay, that's enough of that. Okay, moving on. So they're located in Pennsylvania. Now their cash to debt, they have had no debt, but this year there's new accounting rule that requires companies that have store leases to consider that on their debt. So you'll see on the stock selection guide that all of a sudden it jumped from 0 to 55. Well, this is the answer to that is they now have to account for the what they would owe on leases as part of their debt. And the company has done nothing to increase their debt. And you know, basically, I discount the fact that they have this new accounting rule. I don't think it's a concern to us whatsoever. If you look at Morningstar, they're estimating the sales will grow at 22%, earnings per share will grow at 18%, and the store, they have no moat to speak of. The fair value, according to Morningstar, is 90. That was on March 18th. Their 5-star buy price would be 71.40, and at the moment it's about 80, low 80s. So the star rating was 5. I changed it. I think they would give it a 4 now. If you look at Value Line, they're estimating 17.5% growth, earnings per share 19%, timeliness 3, safety 3, technical 4, with 3 to 5 year appreciation in the 85 to 175% range. Now, if you go, I'll show you with Value Line. This is the last Value Line. It was January, so it's really out of date. I mean, you could see in their write-up that they say the reason that they had disappointing holiday sales. Same-store sales did slip 2.6%. Part of the reason was there were fewer shopping days between Thanksgiving and Christmas. Now, if you want a more up-to-date Value Line information, what you could do is every week Value Line puts out a review of their all of their stocks, and it looks like this. So instead of just looking at the old value line, you could look here, Five Below. And this came out last week. It was at 72.94 was the price. This is the timeliness, safety, technical numbers, depreciation over 3 to 5 years, 130 price 135 to 200. In other words, 85 to 175% appreciation. So I like to look at here because these numbers do change every week. Now, for those of you who don't know, Better Investing put out an email that they're giving free access to CFRA, the Outlook, and you could have free access for 90 days. So this is something they're offering all our members now. And CFRA used to be at the Standard & Poor's. They have a 12-month target of 100 for this stock. Sales in fiscal year 21, 3.6% growth, and 3-year earnings per share growth of 17%. So I did go call up CFRA here. I signed up for their service, and you could call up Five Below on their service. So this is directly from CFRA. They have a buy with a 12-month target of 100. This is a small cap growth stock specialty store, consumer discretionary. And you could see that their growth estimate here is 17%. So anyone who belongs to Better Investing can now get the Outlook for free for 90 days and could call up any stock just like this. So Yahoo, I looked at Yahoo, their 5-year estimate is 15.4% growth in earnings, and Zacks is 24% growth in earnings. So for my SSG, I picked a conservative. Remember, we're looking here with the SSG, like 5-year type growth. I picked a conservative 12% in view of the current shutdown of the stores. Using the preferred procedure, I get earnings per share growth of 11%. Pre-tax profit margin is 12%. Return on equity is 27%. The current PE is 27. The average is 33. And I'll show the SSG in a moment here, but my high price for the next 5 years is 158. The low price I picked, the current market low was 48, which gave me a 2.1 to 1 upside to downside ratio. The peg ratio that's too high, I like to see it below 1.5. This is 2.2. Relative value 82%. So my current recommendation is to buy up to 75. It's currently a hold. Even though they're shut down, about 40% of their costs are fixed costs, so closure will not stop many expenses. The extent of the shutdown is certainly out of the company's control. On the positive side, they still have Holler.com and Nerd Street Gamers, so they're getting some online sales through that as well as their normal website. Toys will increase sales with Toys R Us now out of business. If the U.S. is in recession, I think this is the type of company, being a low-cost, trend-following company where you want to spoil your kids anyway, and you could spend $5 even in a recession. And I think Five Below has that going for it. They're also experimenting with some things being priced at $5.50 or $10 below. Looking at the SSG, you can see here sales estimates of 18.9%, 22.7% from the analysts, and I'm picking 12%. You can see it's relatively up straight and parallel. The sales, pre-tax profit, and earnings per share. Comparing to peers, this is what automatically comes up, and you could change the peers if you want. This is what comes up if you just click compare to peers. Looking at valuation and return, I deleted the this high PE and this low PE. I selected 30 as a high PE. The current PE is 27. The average after I deleted these is 32.6. I selected 30 as the high, giving me a forecast high of 158. I selected a low PE of 20, but I selected the forecast low price I picked was the current, the recent market low. This is the zoning that I get with those selections, and I have a buy up to 75. I'm currently in the hold zone, as I said. So with the current price, the average return would be 9.7%. Forecast using forecast high PE would be 13.8%. I looked at the stock comparison guide here. The closest stock we have in our current portfolio to Five Below is Dollar General. So I selected Dollar General. And also over here, you can see, you can call up just the industry for specialty retail, which this is in. And you can see how Five Below compares to Dollar General and how it compares to the specialty retail industry in general. But Dollar General, by the way, is doing very well right now and is pretty much at an all-time high.
Yep.
So you can see Five Below compares very favorably to both the industry and to Dollar General. One other thing which I like to look at, if you go, I'm using SSG Plus on the website. If you go to research, you can look at, well, first of all, you can go to analyst estimates directly. I already went through that. You could also go to key statistics. I like to look at what's called FinViz, a website. And this gives you a lot of data on the company. You can see the analyst estimates, the earnings per share for the next 5 years. Consensus analyst estimates, according to this, is 15.38%. Like I said, I picked 12%. You can see the debt. They still say the debt to equity is 0, even though the SSG is now accounting for the lease liability. I just wanted to show you what FinViz looks like here. And that's about it. Any questions?
Excellent. Thank you, Ira.
I had one somewhat related question about CIFRA. How do you access getting to the CIFRA reports that is all being offered by Better Investing right now?
Oh, there was an email that they sent out. I don't know if you saw that, Joe.
I don't think I did. I'll go see if I can find it.
I could forward that to you.
Okay. Okay.
And it had a link for how you sign up.
And those sorts of things are sometimes available through your brokerage, right?
Yes, mine is available through the brokerage. I did not know. That may be the reason I didn't pay attention.
Okay.
Yeah, you can get a report through that. But if you sign up, you could get their weekly newsletter called The Outlook, which is down here. And it has back issues as well. Here, I'll show you that. So this is the latest one from, and Sam Stovall is the head of this, and he always has the opening information. And then they have their stars rating, and they go through, they have a focus stock, and they show you how their stars have changed recently. There's a lot of good information here. They have model portfolios as well.
Yep.
New stars, old stars, okay. And since we get it free now for 90 days, you may as well sign up.
For the benefit of any new visitors that aren't familiar with the term SSG, like we mentioned earlier, it stands for Stock Selection Guide. It's generally a tool that was developed, I think, back in the 50s by Better Investing. Back then, it was done on paper, very manually by people that wanted to use it, using usually information from something like Value Line or other analysis sources. Now it's been computerized, and this current manifestation is online completely. There's also a standalone piece of software called Toolkit, which does basically the same thing. But in a nutshell, it takes in key financial information from the company and then distills it down into some very pertinent visual charts and tables where you can kind of quickly sort through companies that meet your criteria. Like, we're looking for consistent and upwards growth rates of revenue and earnings per share, and no major fall offs in earnings per share or profits or anything like that. So this stock selection guide is a way that is generally our main tool that we use each meeting to go over stocks and present them in a kind of in a common language that we all understand.
And one other thing I wanted to show the quarterly data, and I know, Steve, you always look at this. Here's the miss that they had in terms of their earnings. And then you can see it came right back. And I am sure the next quarter will be a disaster. And I'm looking, I am looking at least a year, 2 years down the road in terms of where this stock will be at that time.
As far as my analysis goes, this is an old favorite. We've had Five Below on our wish list or watch list, I think, for a while. It seems to be a great company. I was kind of I appreciate the heads up before your presentation, Ira, because I ran the numbers and it was in my hold zone. So I was curious to see what aggressive growth rates that you had been assuming. But then I can now understand that if it popped up $10 or so, it got out of the buy range. I think I used similar values to you. I think my buy was up to 73 and yours was like 75. But you brought up a good point that I guess I tend to agree with, that in a recession and money's tight, I would imagine that places like this that are lower cost but still give a perceived good value on the merchandise that they sell, this would tend to do fairly well in a recession environment. That's just my guess though, but that was a good point to bring up. Did you mention like the 10 and below? I'm assuming that's $10 merchandise in their existing stores. They're not planning on opening up like 10 below named stores, right?
It'll be the same store.
Same store, yeah, okay.
They're just experimenting with some higher prices.
Yep.
Gotcha. Okay.
Ira, thanks for clearing up the confusion about their debt in quotes, because the different companies do different things with it. Morningstar said they had debt. Which I guess is why it showed up in the SSG, because it said they had debt, but it's just a change in the rules. So that was confusing to me.
That was an accounting rule that was put in place in 2017 or 2018, but didn't go into effect until the annual reporting at the end of 2019. And we're going to see most retail type companies that rent their space, that number is going to jump up very, very high by comparison to what we saw in the past.
Ira, the only report that I saw that even mentioned the pandemic was Morningstar. Did you see anything else that talked about the pandemic effects on them?
I know the CEO did an interview, and
I saw some stuff that they put out about what they were doing.
Yeah, he's saying the same thing every other retail company is saying, basically. Yep. But this company, I'm still saying they have no debt, is one of the stronger retailers, and they can survive this, and they can survive a recession.
Yeah. Yeah. Thank you very much.
Steve, do you have any comments?
Yeah, as usual. Ira, I just want to compliment you. I think you did an excellent job presenting the stock. You did a really good job. You might have even swayed me to even want to buy it. First I'll start off with the positive thing about that I found. So since this wild market, I've been hunkering down and looking for indicators such that companies won't go bankrupt. And one indicator that I've come up with is the Altman Z. And Altman Z has been around since '68 when it was invented, and I didn't know about it until I started Googling these things. And so what it boils down to is this. Anything above a 3, they're pretty good that they're not going to go bankrupt. If it's 3 or below, it's kind of iffy. And banks, you will throw it out, right? So banks are different. So their Altman Z is 4.13, which is phenomenal. So we'll start off with that positive. And then we'll go into my list of what I don't like about it. So it's kind of got a small problem now. All its stores are closed, unlike Dollar General. That's why Dollar General is performing. So that kind of really bothers me. And it bothers me for the following reasons. So I see the recovery from pandemic as two phases. One, once the antibody test comes out, everybody that's had it now, hey, once you have the antibody, then you can go out and do what you want. So that's going to start rolling out. Things are going to start getting back to normal. But those who haven't been exposed are going to have to wait for the vaccine. And you're looking at about 18 months. So I think you're going to see very earnings in the mud for at least 5 quarters, 6 quarters of terrible earnings on something like this. So I don't know. Yes, it's going to do great, but now Fauci said that the antibody test was coming out in a week. Haven't seen it, and they're going to have to roll out a hell of a lot of it. So I don't know. That's just my take on that. The other thing here is I checked the Fidelity's analyst ratings. So it had a very low analyst rating of a 1.3. So on a scale of 0 to 10, so the analysts are, well, so that wasn't too hot. Also, now you can take this as a positive or a negative, but the demographic to me is extremely narrow. So the demographic is post-millennials, and they're really Gen Zers, Generation Z. So that's the 7 to 22-year-olds currently. That's who shops there. That's it. So the question is when the stores start opening up, are the Gen Zers going to flock to Five Below? Or are they going to go to somewhere else like Dollar General? I don't know.
Gen Zers and
made it a very appealing.
Don't forget that Ira buys there.
Very, yeah.
Don't forget that I shop there.
Yeah, right.
I'm
okay,
a
that's true. Well, and I'm sure your dwell time was very high.
Very slow
so,
now.
Yeah, right, very low. So when I did my SSG, I just cut all the sales and earnings in half, and I came out with a 68.5 as my buy. So it was way under, not ultra way under, but it's lower. And the 52-week low on this is $47. So I can't imagine that we're going to be in a V recovery. I think it's going to be more of a U-shaped recovery with this. So my feeling is it's going to be testing its 52-week lows with this. Which now then, if you can get it around 47 again, I think that's going to be the real buy point here. But yeah, it's not something that I would have considered, but certainly after your presentation, it's very, very strong. It's definitely something that I would consider getting. So that's my analysis. Thank you.
Okay. Thanks for that. If there's no other comments on Five Below, let's move on to the review of our current portfolio. And just to note, Joe, if you have to drop off, just let us know so that we can keep track of the questions that are being answered.
I'm doing fine.
Okay, thank you. Okay, I will start off then. FleetCor Technologies, the only news I saw was that Comdata, which is one of their holdings, came out with a technology called QuickPay, which is a new financing solution that gives fleet owners access to same-day payments on the loads they deliver instead of waiting a standard 30-day for their payment. So that has the potential to get money into the hands of the trucking companies and other, fleet-related companies much shorter time than what's currently being done, which could be a boon for those companies. I didn't see whether the people that are paying for the shipments will necessarily sign up for this, similar to a company that has 30-day net or other financing terms. But at least this technology exists, and they're hopeful that it'll be attractive to fleets and their customers. For Athene, for FleetCor, I have them in the buy zone. They're currently $224, and the buy is up to $233. For Athene, they said they were selling $500 million worth of senior notes to fund general corporate purposes, including support of investment opportunities, organic and inorganic growth. And I think those notes were fairly high rated in value. A new value line for this company came out. Their stock price was hit along with the other companies, but 2019 was a strong year, and they're expecting about 12% growth through this year. I currently have them in a buy range. They're at $30.35. The buy is up to $49. And then for Tractor Supply, a lot of news articles on their COVID-19 responses. They're keeping their stores open because they're considered essential, providing feed for livestock as well as other materials and supplies. They said that they're hiring over 5,000 people in these times, so they're going on a hiring spree, and they're expecting good, somewhat reduced compared to before the pandemic hit, but still fairly strong sales and earnings. They have a strong online presence as well as rolling out, I think, curbside delivery and other different approaches to get products into people's hands while this shutdown is going on. I currently have them in a hold range, though. Their current price is $88. The buy is up to $66. And that's it for me. Steve?
Yep. So first we'll start with Middlebury. There was absolutely no news on them. I was really scratching for news. But what I will talk about is their 52-week high was 142. Their 52-week low was 41, so you have a $100 swing there. Their current price is $58, and they're in my buy zone. So I have a buy on them up to 94. That's pretty much all I have about Middlebury, other than I think that with everybody staying home and not going to the restaurant, they're going to be stressed for a while. What I'll do is I'll jump to Visa next. Of course, Visa, there's always news. They've teamed up with Fold to work on some Bitcoin stuff. I didn't get a chance to understand that completely, but it certainly looks very promising. And the other super promising thing, of course, there's some nice collusion between Visa and MasterCard, and they're signaling that they're going to start raising rates. Why? Because I'm assuming their volumes are going down. And so they're going to just raise the card swipe rate. So who doesn't love a monopoly? Their 52-week high was 214. Their 52-week low was 133. And so you can see these big swings again. They're in my hold range right now. I have a buy up to 153 on them, and they're currently at 172. Google, of course, advertising is getting myrtleated right now. It is really getting crushed. So they're gonna have a poor showing, even though people have been Googling like crazy. I think the advertisers have turned that valve off. So you're gonna see they're gonna have a tough few quarters coming here. They're teaming up with various companies to try to help detect the virus. So they're trying. And they're like Google Classroom is taking off. So they have a lot of initiatives that are Corona-centric that are promising. Their 52-week high was 1532, and their 52-week low was 1013. My buy range, I have them up to a buy up to 1352, and they're currently 1211. So they're in my buy range right now. They're a company that is a fortress balance sheet, probably the best balance sheet on the planet, and that's something that I would consider buying at this point. Thank you.
Okay, Lithium is reporting results on the 22nd, so there's nothing much new to report. I have them as a buy up to 124. They're now at 84. And Gentex also, they're reporting on the 24th. I have them a buy up to 27. They're now at 24. Regeneron is making new highs, and that's because they are developing the antibody test. They're also working on an arthritis drug. They're working with the government on all this. And, things are looking really up, favorable for Regeneron. And of course, with their high price, I have them as a hold now. I have a buy up to like 370 or so on Regeneron. But I have.
Okay. Essent, I just lost my piece of paper. There it is. Essent is down about 20% from its high. Its earning report is May 1st. Next one. The estimates show it'll be down a little bit. We'll see what happens. It's a buy. Apollo General is doing well. They're hiring like crazy. Its next earnings report is the end of May. The PE is now over 25, which is like its record high. It's not quite at its record high price, but it's close to it. It's now almost 14% of our holdings. And if this was normal times, I'd consider selling some of it, but it's not normal times. It's a hold. Ulta is also reporting at the end of May. The consensus estimate, what the analysts predict is that the year-over-year sales be down 40%. That's pretty conservative, if you ask me. They do have a pretty big online component, but not that big. It's also a buy. I think we really don't know how these how these businesses perform until another 3 to 6 months. That's it for me.
Okay, thank you. Anything from the watch list?
The watch list, yeah, I reported on 5. Where's my, jeez. I have too many pieces of paper here, sorry. almost everything's in a buy. Our watch list is Viva. Excuse me, just a second.
Sure.
I need to find it.
I think it's Viva and Facebook are the other two on the watch list.
Yeah, they're both buys.
Okay.
Oh, and BSTC, Biospecific Technologies, is a buy.
We took that off.
We did? Okay.
Okay. Well, thanks everyone for the status of the current holdings. Now we move on to any proposals for buy or sell.
Well, I would move that we buy Middleby, which is our lowest percent holding right now. We'd like to get our stocks up to an equal 7 or 8% in that range. And I think Middleby is strong enough to come back. At this current low price of 58, I think it's it's well worth adding to with our $795.
Right. I'd be okay with that. Jack or Steve?
Good.
Comments? Okay.
Yeah, that's fine.
Okay.
And Jack, you'll do the buy still?
Yes, I will.
Okay, that's your job.
Great. I have to take some time off from playing video games.
That's good. Any other buy or sell motions? Okay. Hearing none, we'll keep on trucking then. The only old business that I had, Ira mentioned in an email, was regarding the standard of conduct signature with Better Investing. I think, Steve, they had you as set to inactive or something like that, so you should have gotten an email.
Yes, I just got the email Friday night, and I will, right after this meeting, I'll actually do it, otherwise I'll forget. So I will do that right after this meeting.
I also sent you a follow-up email with instructions.
Yes, it was very detailed. Thank you, and that's another reason why I'm gonna do it right away.
Yeah.
So
I stole it from an email I got from somebody else. I didn't create all of that.
Okay. I didn't have any other new business or anything to go over. And just a mention that for our main meeting, I'll be presenting stock study. And Jack, you're on the hook for the education segment.
Yep. Yep.
Okay. Okay.
Any other questions, Joe, from the guests?
I think I've gotten all the questions answered. There aren't any any new ones posted right now.
Yeah, it looks like there was a bit of activity there. So thank you, Joe, for answering those.
You want to open up the floor to anyone who wants to talk or not?
It's up to you guys.
I was asking Brent.
Yeah. Yeah, I guess if you're still with us as a visitor and you have a question that you'd like to ask, you should be able to raise your hand in the attendees little panel in the control panel, and then Joe can unmute you and you can ask your question. Otherwise, I'll show on the screen now should be the email address of Jack Finn, who coordinates kind of questions and potential new members. So his email address is there. If you have any follow-up questions or think of them after we hang up, feel free to email him and he can answer them. Also like to mention that our next meeting is, again, second Saturday of May, 11 a.m. Eastern. We'll be doing basically the same format. I'll pause a moment for anyone to to ask questions. I think Laura Scott has her hand raised, so I will unmute. I'll try to unmute her. Or Joe, can you try to unmute Laura Scott?
Let me see what I can do here. Laura, you should be able to speak.
Okay, hi guys.
Hi.
Is there a limit to where you live in order to join your club, as far as tax purposes go?
Yeah, the only limitation is some certain states require the club to file a tax return on your behalf. That would be the only limitation. Otherwise, if there's nothing else, we don't, because we're online. There's no geographic limitations other than the tax requirement.
Okay, and I believe I may have shared your meeting out several places. I didn't know if you wanted visitors or not, but I saw it out there on Facebook, and I think I may have shared it to other places. Is that okay?
That's fine. We are,
Absolutely.
we're an open club. It's basically a model club. That's what we are. So I would encourage them that if you share the whatever the registration link is, so they can go and sign up and then get an email with the invitation on instructions on how to log in. But yeah, we're open to new members or just observers if people want to just come and see how it works, look at the various companies that we review and discuss those things. We're open for that.
That's great. Yeah, it was a great meeting. I'm in Florida, and we also have a model club that we do online, and I know there's several other better investing chapters that do online clubs, and I enjoy attending all of them. So thank you for opening this up for everybody.
Great. Well, thank you for attending.
We have another question out there. I'm going to turn Kilpal Parmar. I'm going to turn your voice on so you can ask that question, please.
Hello.
Yes, you can speak. We can't hear you, Kilpal. His question was, could you repeat the name of the indicator used for 5 below, where the comment was it was above 3? I was typing at that time, so I don't know the answer to that question.
Yeah, that was the Altman Z.
Oh, okay.
So the Altman Z indicator. So, and it's above 3. It's 4 point something.
Where can you get that?
Chartmill. Chartmill.com. CHARTMILL. That's where they have that, and it's free.
Thank you.
Yeah.
While we wait for Kirpal, I think Eustace has a hand up. If you can unmute them.
Okay, Eustace.
Yes, good afternoon, everyone. First off, thank you for awesome presentation. Learned a lot and really appreciate it. My question is more around, I recently heard about Better Investing maybe about a week and a half ago. And initially, my partners and I were planning to start our own investment club. We're all located in New Jersey. The question that I have for you is actually two-part. If we want to continue down that path, is that something that you, someone from this team would be able to help us with as far as getting it off the ground? And if not, I guess we would, probably look to join your club.
How many folks are you talking about?
There's 5 of us in total.
I would leave it up to you guys to make your own decision, but
I think it would be fine if you joined us to learn how to do the stuff, and with the view of starting our own club as you learn enough. but the better investing people will help you, and we can help you set up your own club.
Awesome. Okay. Thank you very much.
If you need some help, you might want to email me. I might be able to give you some help with that, Eustace. My email address is cjfarrell46@comcast.net. I'm an officer with the online chapter, and that may give me you a path for some additional assistance.
Awesome. And again, that's cjfarrell46@comcast.com.
.net.
.net. I'm sorry. I heard
No
net
problem.
and I wrote com. Thank you.
Yes, sir. I understand. We can talk that way. I'm also the one that's running this piece of software. So if y'all want to get together and sit down and talk back and forth as a group on this stuff, we can do that also.
That would be great. Thank you very much.
I can help point you toward working with these guys because they do a good job. Okay?
Yes, very impressed. Thank you.
Okay. Looks like we're all set then. If nothing else, thanks again for attending. Hope to see you back a month from now on May 9th, 11 a.m., same time. Any questions pop up that you think of after we log off, email Jack, and we'll go from there. Okay, thanks everyone. Joe, if you figure out how to log on the questions, if you can send them to me and I can roll any frequently asked ones into the presentation for next time.
Yes.
Okay.
If I can figure out how to do it. Okay?
If you can figure it out, exactly. Yeah. Okay. Thank you, everyone. Stay healthy and hope to see you next month.
Thanks.
Bye.
Bye-bye.